This week on Wealth Track, as investors dump stocks, two great value investors are loading up. Davis Fund's Chris Davis and Wintergreen Fund's David Winters are sifting through the rubble and finding many high-quality gems. Great investors Chris Davis and David Winters are next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Two of the major investment trends we are monitoring regularly on Wealth Track have become more pronounced. They are related and they have the potential to hurt investors over the long term. Our goal in today's show is to put them into perspective and help you deal with them with the help of two seasoned value investors, the Davis Fund's Chris Davis and Wintergreen Fund's David Winters. One is market volatility. The other is how investors are reacting to it. Now, we all know the story of heightened market volatility, the big swings we've experienced in the stock markets at various times this year. 3 to 4% moves in a single trading session and double-digit swings in matters of weeks and months have rivaled those during the 1987 crash and the worst of the financial crisis. All very unsettling to investors. And investors are reacting accordingly. They are fleeing the stock market in droves. As this chart from independent research firm Bianco Research illustrates, net new outflows from domestic equity funds, essentially the difference between investments in and redemptions from the funds, increased dramatically during the financial crisis of 2008 and 2009. And after a brief pause, have accelerated again since last year. Some analysts believe with 2 months to go, U.S. stock mutual fund outflows are on track to surpass the record set in 2008 and the near-record outflows of last year. Why could this stock exodus hurt investors? Well, our two great investor guests believe the value to be found in high-quality global brand-name company stocks has rarely been better. Chris Davis is a third-generation value investor at the Davis Funds, which earns the highest marks for shareholder stewardship from Morningstar. Chris is co-manager of the family's flagship New York Venture Fund, among others. New York Venture has an excellent long-term track record. It is the only mutual fund to outperform the market in every 10-year period since 1970. But like several other top value-oriented funds, has been underperforming its peers and the market of late. Such is not the case with David Winters, founder of the 5-star rated Wintergreen Fund. Winters is a longtime global value investor who launched Wintergreen 6 years ago as a go-anywhere, invest-in-anything fund. He has done just that and has beaten the market and competition by a wide margin during this difficult period, which is why we are delighted to have his firm Wintergreen Advisors as a sponsor and David as a guest. I began the interview by asking Davis and Winters why they feel this is the wrong time to flee stocks.
I think one of the peculiar things about stocks is it's about the only thing on earth where the lower the price goes, the less people want it. So here we are after a decade of falling prices and rising profits, and now people want to get out of stocks, and worse, they want to get into what's already gone up where prices are high, which is things like bonds and
Treasuries.
Treasuries. Right. And so, if you think about a pizzeria that earns $100,000 a year, if you could buy it for $2 million, your return would be 5%. If you could buy the same business at $1 million, your return would be 10%. So lower prices increase future returns. It's as simple as that. So here we have lower prices, higher corporate profits, and now people want to get out of stocks simply because the prices are down.
Just because prices are down doesn't mean they're going to go up. And so what kind of returns, number one, do you think we're going to get from stocks in the future, or the kinds of stocks that you are buying in the Davis Fund's New York Venture, for instance? And when do you think the market is actually going to pay off? Because it hasn't paid off if you bought the S&P 500, certainly for the last 10 years.
Well, I don't know when. In this sense, it's always unpredictable what the market will do in the next 6 months, the next year, even the next 2 years. But if you focus on the underlying businesses and you think of your return being based on the earnings the business generates. So right now you could buy the S&P 500 or a representative portfolio of really high-grade durable companies, and you would get about an 8% earnings yield and about a 3% dividend yield. So when you think about returns, the best place to start is the returns of the business. Over time, the stock prices can gyrate up and down, but the returns that you should get as a sort of a benchmark starting point should be based on the earnings yield of the underlying businesses over time.
All right. All right, so for the defense for stocks, so David Winters, why do you think it's a big mistake for individual investors to be fleeing stocks in droves at this particular moment?
Well, first of all, I agree with everything Chris has said, and I think you're right. Mm-hmm. But I think what's also...
That makes me feel much better.
but I think the key thing is that a lot of companies, their underlying earnings are growing at a rapid clip. And today, people don't factor in a bright future. People basically think the world is going to end or it's going to do nothing. And the tone is so gloomy. So, the irony is that people become momentum investors. When anything goes up, they chase it. When it goes down, they don't want to have anything to do with it. So we've had 10 years wandering in the wilderness in which stocks are cheap and also the world around us keeps getting better. And so I think that, Consuelo, if we look forward, stock returns will probably be pretty good, especially compared to other assets.
So what's better about the world? I'm looking at kind of, Europe falling apart. I'm looking at, gridlock in Washington. I'm looking at even China, Brazil, India. Their growth rates are slowing. They've got problems there. What's better?
Well, I think a lot of things have changed. You have a couple billion consumers who've joined the party, and they want everything we have. The access to information is just changed dramatically. I remember having to go to the library. Now I just go online. And so I think a lot of things are improving. And if you can find these businesses that are well positioned to capitalize on this, tectonic global shift in economics, I think people are going to make a lot of dough.
We're in a world now where there's such fear, there's so much of a sense of uncertainty that it is in the prices. It's not that we don't believe there's uncertainty, but more that it's discounted. And the dangerous time to invest is when people don't think there's any risk. That's when they get killed.
And the other thing is, if you just look at history, and history is not necessarily a prelude to the future, but the world has worked through all kinds of crises. And I think the thing where investors are not focused on is inflation. And I think inflation is really something to be very concerned about. I bought some crackers last weekend. Well, I thought I bought 8 ounces of crackers. There were really 7 ounces of crackers in the box. And I think that is indicative of what's going on.
The naysayers and they've been on Wealth Track, have told me basically what they're seeing is a global deleveraging happening. And that as governments who are way over their heads in debt, as consumers who have been way over their heads in debt, are deleveraging and paying off that debt, in fact, that the demand for goods and services is going to diminish for a number of years. And there's that economic theory out there. This time it's different. So what about that countervailing force, which is the deleveraging, which is a deflationary force? Doesn't that impact your businesses?
Chris?
Well, let's start with a company that we both like, right. Nestle. Now, do I really think that Nestle is going to sell less product in 3 years than it sells today? Right? With all of do I think Colgate will sell less toothpaste? Do I think Coca-Cola will sell fewer Cokes? The U.S. is 5% of the world's population. Venezuela is the 6th largest beer market in the world. Heineken makes more money in Nigeria than in the United States. So we have this view about, what's happening in Europe, what's happening in the U.S., without going through and thinking about the business. If the three of us together owned all of Nestle, and we were looking at what was happening in Europe, what was happening in the US, I don't think for a moment we would be worried that our sales 5 years from now would be lower than they are today.
But aren't those still big markets for Nestle, for instance?
Yes, but they're
And doesn't it impact them, let's say, for the next 3 or 4 years as we get through this problem in the developed world?
I think the question is, will these sorts of consumer staples, are people going to buy less of those? Now, will real estate prices in Europe go down? Will there be a financial crisis? Are banks in trouble? Who knows? It certainly looks that way, right? But what that has to do with what Heineken sales will be or what Nestle sales will be? I think there, you can look through other periods of turmoil, dislocation, and as David says, we spend a lot of time talking about deflation and slowdown. We don't spend a lot of time talking about inflation, and yet over all of our lives, if I just look at the last 75 years, the value of $1 is down 92% in purchasing power. So that is a constant headwind of people losing purchasing power, and yet here they are locking in. They think that the safest place to be is in a bond yielding 1.5%. So I think you think through to the pricing power, the underlying growth, and I will tell you the growth of this middle class worldwide so grossly swamps what a slowdown in Europe will do to a lot of these global multinational companies in terms of their long-term value and growth.
So this has been a theme of yours, David, and we had a fascinating conversation the other day about kind of some of the universal truths that can guide one's investing. So what are these universal truths that people all over the world are feeling?
Well, I think that everybody wants a better future for themselves, their families, their friends, and their pets.
Right, and their pets is an important part too. Speaking of Nestle, yeah.
and I think that's very, very important because people do want a better tomorrow, and I think everybody wants to look good. I mean, they really do. I think it's a real basic motivation. In all my travels around the world, people may express it differently, but they want to look, whether they're male, female, they want to look great.
So therefore, a company like a Richemont, which owns Cartier or Van Cleef & Arpels, and yeah.
Right. I mean, it's happening everywhere. There's huge opportunity. And then the other, I think, universal truth is that people want to have a good time. And it's really, you can only be gloomy so much. Mm-hmm. And so people want to have fun, whether it's riding your bicycle or, whatever people do. And
so a company that is in the Wintergreen Fund that exemplifies that is something like
Genting.
Genting, all right. And explain to our viewers what Genting is because they probably don't know.
It was a small Malaysian conglomerate that had a gaming business, still has a gaming business in Malaysia, and they diversified. They have a duopoly in Singapore. They now have Aqueduct here in Queens. And it's incredible. And, who would have thunk that, a little Malaysian company would end up being a huge global success? And they're great. They're great operators.
Where investors are having a really hard time with what you're saying is the fact that we're seeing this market volatility, just heightened market volatility, and also market correlation. What's your perspective, and how do you handle it as a money manager?
Well, I think it used to be that assets weren't correlated. And now that everything, first of all, that you've got 24-hour news channels and all of this, and all the electronics.
And high-frequency trading.
Right. But I think what we do is we try to take advantage of the volatility. And a lot of the principle goes back to what Ben Graham wrote about in the 1930s, which is Mr., or now we call it Mr. or Ms. market. And we'd say that, you take advantage. So when the market goes down, we have a pretty good sense of what we think a company is worth. And we buy it on sale. And when the market's way up, we don't buy. And we view this as one of the most exciting and productive times, certainly in my career, because it's like being a kid in a candy store. And so we carefully deploy shareholders' capital, and like Chris and his family, we have all our own money up. And that really changes your behavior as an investor and an asset manager when your bacon is frying with everybody else's bacon.
So, David, so what have you actually been doing when you say you're taking advantage of the kind of market volatility? And I noticed that you said you've been upgrading in the quality, and I always thought that you had really high quality companies to begin with. So give us an example of what you've been doing.
Well, what's so unusual is that the best is on sale. AAA is on sale now, and usually as a value investor, you had to buy a can of dented soup. Mm-hmm. No longer, or soup with a dented can. Mm-hmm. And You know, what have we been doing? I mean, we've been adding to really high quality companies around the world. I mean, we bought more Genting, we've bought more Richemont, we've bought, we've added to oil and gas because we think that it's a diminishing asset and it's very hard to get. And then there's all these consumer companies that make things that people absolutely have to own. And so, anyway, I'm enthusiastic. I think that this is a wonderful time.
Consuelo, when you said, people could buy a stock today and lose a lot of money tomorrow, this is the big disconnect. You see, there's a difference between price and value, right? Price is what you pay, value is what you get. Now, if somebody watching the show owned an apartment building, right, and they paid $1 million, had a few units in it, and when they bought it, it generated $70,000 of income after the expenses. And a few years later, it was up to 80 or 90,000. The fact that what somebody might pay for that building could swing all around, right? There might be one day somebody would offer them $1.5 million, and the next day there's no bid. That doesn't mean the value of the building has changed, just because the price has changed. So going back to what you said, people can lose a lot of money buying stocks today, tomorrow. It depends what the business is worth. Now, if they're forced to sell, then you're absolutely right. Stocks are a very dangerous asset class to be in if you're thinking, I need to raise money for 3 months from now or for 1 year from now or 2 years. But if you can get in systematically over time, then lower prices and volatility, just like David said, is your friend. And if you can think of the underlying businesses and the difference between price and value, then the market volatility becomes much less unsettling.
So you're an advocate of dollar cost averaging, essentially,
Yes.
in high quality companies.
It's huge. It's something that works so well. It's no wonder that Ben Graham wrote a chapter about it, that it met, and yet somehow people think, no, when prices go up, I get more excited because the world's safer. I'll invest more. When prices are down, I'm panicked. I'll wait on the sidelines for it to get better. That is destructive, self-destructive behavior, and investors destroy the returns over time by getting in after things have gone up, getting out after they've gone down. If there's one thing they could change, it wouldn't even be to reverse that. That's too hard. But if they can simply be disciplined, do the same amount every month or every quarter or every year, average in, rebalance, have that discipline, they'll be get very satisfactory returns over time.
So one of your hallmarks, David, as well, is you've purchased a lot of internationally based companies. Is that still going to be a major theme of yours, that it's, rather than be a U.S.-centric or U.S.-based company, that you're looking even for companies that are not only doing business overseas, but that are actually based overseas? Why has that happened the way it has?
I think the world it's become smaller. And it used to be that, the U.S. was sort of economically the center of the world, and we aren't anymore. And so, with the market really selling off, we bought more U.S. companies. So
you have been buying more U.S. companies,
yeah.
again, because the prices are attractive. Yeah.
Correct.
I
like
mean,
we
such
bought
as
MasterCard.
MasterCard. All right.
And we own the Norfolk Southern Railroad. And but what we've really found is that there's all these great companies based around the world, and that they no longer have to be based in North America. Who'd have thunk it? But the world has changed, and that's what I mean by the world has changed for the better, because a lot of these folks were educated here or elsewhere, and have taken the principles of, and applied them at home. And so I think that's why I'm excited. I think that there's really an entrepreneurial bent in the world, and that usually brings prosperity and better health and better lifestyles. And
you both are self-described value investors, and you both own Google. So David Winters, I never thought I would see Google in the Wintergreen Fund. Tell me about that one.
It was really simple. First of all, it's a great product. And I think the economics of a business are actually getting better. It's becoming more global. They keep innovating. But you could just take the cash, strip the cash out of the stock price, and you were paying, I think, at 1.8 times earnings. And the management seems to have they do no harm ethos, which really is, I think, very powerful.
And it creates so much value for the advertisers. I mean, the people that advertise on Google, whether they're auto insurance companies or trial lawyers or pizza shops, they'll tell you those are the best dollars they spend in advertising. Better than cable TV, better than newspapers, better than broadcast media, better than magazines. The best dollars they spend are the dollars they spend on Google. So it's hugely valuable. But I would touch on one thing David said. I would say I agree. I actually also have a very high regard for the management in terms of their fanaticism, focus, culture. The one concern is capital discipline, because one of the things we've seen over and over in technology is these cash piles build up, and management somehow says, well, we're rich, we're entrepreneurs, we have plenty of money, we'll just keep that for a rainy day. They've used share repurchase as somehow an admission of failure, and yet they don't look back and say, what's been the best performing tech stock for the last 70 years, right? IBM. Mm-hmm. One of the things that made IBM great was capital discipline. And I think Microsoft
buying back shares.
Yep.
Right.
I think Microsoft has got that message. I think that you're seeing a generation of technology companies, and that's the one thing I worry about with Google, is this idea that we will spend that money however we want, doing whatever we want, versus, everything you say about the fanatic culture of management, I love. It's the capital discipline lurks in my mind as the one.
Are they going to listen
concern.
to you?
I don't think they'll listen to me.
All right. So one investment for a long-term diversified portfolio. Speaking of great ideas, what's the one thing we should all own?
Well, I mean, if you want a nice, easy one, you could buy something like the Norfolk Southern Railroad. You're going to do well. Mm-hmm. I mean, you may not do spectacularly, but you're going to do fine. I mean, you get a nice dividend yield. You can't replace the railroad, and they have coal, and it's well run. I mean, that would be a U.S. company that I think is just. And then,
so no ease of entry there.
Oh, you can't.
Right.
And it's irreplaceable.
Mm-hmm. Do you own Norfolk Southern?
Well, I would say we own Burlington Northern. And that's the one that I would pick. You see, is what
because of
Berkshire. So what I say is, I always hate picking a stock. I think there's a Murphy's Law about it. We have maybe 40 companies that are 80 or 85% of our assets. And whenever somebody says pick one, I always think, well, there's a reason we own more than one, because there's so much uncertainty. But there's a Murphy's Law that whatever one I pick, then it seems to have a bad headline about a week later. But I think if somebody is watching and is thinking about buying one company, then I think it really has to be Berkshire. I think in Berkshire you get some exposure to financials, you get some technology now, you get the Burlington Northern Railroad, you get Geico, you get Wells Fargo, American Express,
IBM.
Right. And even though, of course, we all know that Warren's not immortal, although we're all hoping, but the valuation of the businesses altogether is reasonable, and it's a peculiar culture that is really run deeply with a sense of stewardship. So I think if anybody was going to say, I'm going to buy one stock and put it away based on your recommendation, I always pick that, because in itself it's diversified and it's run by people that really think of their shareholders as having the vast majority of their worth in that single enterprise.
And David, last word to you on Berkshire, because you have been in and out of that stock over the years.
Are you a high frequency trader?
No, actually, we own Berkshire.
You own it, but less, right? Than at one point you did.
Yeah, and I think we like it, and I think it's I think you're going to make money. I think the thing that's so unusual now is that again, going back to the kid in the candy store analogy, there's so much to look at, and one of the big problems for Berkshire is it's so big. And so your compound rates of return from here will probably be fine. Yeah. But, I think there's lots of, 40-cent dollar bills and Swiss francs and all kinds of other opportunities to be had. And that's why, we're optimistic.
And
so your advice to individual investors would be, David?
Well, I think individual investors, if they can find an active manager that they feel comfortable with, that makes a lot of sense. If they have the ability to actually do analytical work, there's companies, by Procter & Gamble, you're going to be fine. You probably own Procter. And yields 3%, 3.5%, 4%. But I think this is a time where I think you can create a lot of value for yourself if you have the patience and the fortitude.
Patience and fortitude. So we'll leave it there. David Wintersman, great to have you on Wealth Track. And Chris Davis, it's lovely to have the two of you together from the Davis Funds. Thank you so much for being with us on Wealth Track.
Consuelo.
At the conclusion of every Wealth Track, we try to give you one piece of advice to help you build and protect your wealth over the long term. This week's action point is avoid what guest Chris Davis calls the investor behavior penalty. Now, historically, individual investors have failed miserably at timing the market and have been penalized as a result. Over the last 20 years, for instance, the average stock investor has both underperformed the market and stock mutual fund returns by substantial margins. The reason? They tend to buy when everyone is optimistic and stock prices are rallying, and sell when pessimism prevails and stock prices are falling. Buy high and sell low. We just heard Chris Davis and David Winters talk about the values they are finding in the highest quality global brand name companies. It's a theme we've heard repeatedly from many of our great investors, and it is a message worth listening to. Well, we hope you can join us next week. We have a gift for you for Christmas weekend. 2 blue-chip financial advisors who are offering top-notch financial planning services at very affordable prices. Cheryl Garrett and Mark Cortazzo will tell us what they are offering the little guy. And if you want to see any of our programs 2 days ahead of the regular broadcast, check out our Wealth Track premium service on our website. We are also offering exclusive podcasts with other great investors, including my most recent conversation with legendary value investor David Dreman. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.